Imagine a world where investors are pouring billions into companies with little more than a website and a dream. Welcome to the dot-com bubble, a period where the promise of the internet led to unprecedented market frenzy and ultimate collapse. The dot-com bubble, a defining event of the late 1990s, was driven by the rapid expansion of internet technologies and an insatiable investor appetite for tech stocks. The bubble began to inflate as new companies launched, promising revolutionary changes to the way we live and work. In a landscape where traditional metrics of profitability were often ignored, the excitement surrounding the internet created an environment ripe for speculation and inflated valuations. The birth of the internet economy. The early 1990s marked a transformative period for technology. The launch of the Mosaic web browser in 1993, followed by Netscape Navigator in 1994, brought the World Wide Web to the masses. Online shopping saw its debut with Amazon's launch in 1995 and eBay's in 1996. These innovations laid the foundation for the internet economy, sparking both public and investor interest. By 1998, internet-based companies were rapidly emerging, attracting billions in venture capital funding. The number of internet startups surged from a few dozen to over 1,000 within a few years, with investment amounts skyrocketing from $2 billion in 1996 to over $30 billion by 1999. Venture capitalists, eager to capitalize on the internet boom, poured money into tech startups. In 1998 alone, venture capital investment in the technology sector reached a staggering $17 billion, up from just $4 billion in 1996. The excitement was palpable as new companies with innovative ideas and flashy business plans attracted large sums of money, despite often lacking viable revenue models. Investors were driven by the allure of easy money, fueled by media hype and the fear of missing out, FOMO. The psychological impact of witnessing rapid success stories like Amazon, which saw its stock price surge from $1.50 in 1997 to over $100 by the end of 1999, created a bandwagon effect. The hype surrounding the internet led many to believe that any tech company could achieve similar success, fostering a speculative frenzy. The explosion of dot-com stocks. The late 1990s saw an unprecedented number of initial public offerings, IPOs, by dot-com companies. In 1999 alone, 457 tech companies went public, raising over $60 billion. Companies like Amazon, eBay, and Pets.com saw their stock prices soar, with Pets.com, for instance, reaching a market valuation of $1.2 billion despite losing money. The IPOs were characterized by high valuations, with many companies trading at hundreds of times their earnings, a stark contrast to traditional valuation metrics. Investor behavior during this period was marked by speculation and a willingness to invest in unprofitable companies based on hype rather than fundamentals. The Nasdaq Composite Index, which includes many tech stocks, soared from around 1,000 in 1995 to over 5,000 by March 2000. Graphs and charts from this period show dramatic price increases, followed by an equally dramatic collapse. Media coverage and celebrity endorsements played a significant role in amplifying the bubble. High-profile investors and tech moguls endorsed various startups, contributing to a sense of urgency and excitement. The relentless media buzz created an environment where the fear of missing out drove more and more investors to jump on the bandwagon, further inflating the bubble. The role of venture capitalists and analysts. Venture capitalists were instrumental in fueling the dot-com bubble by providing massive funding to startups with questionable business models. By the end of 1999, venture capital funding had reached $105 billion, with significant investments in companies like Webvan and Cosmo.com. Many of these companies, despite their high valuations and large funding rounds, were unable to achieve profitability, leading to eventual failures. Analysts contributed to the bubble by issuing overly optimistic forecasts and promoting unsustainable business models. The proliferation of buy ratings and exaggerated profit projections created a false sense of security among investors. For instance, analysts projected that some dot-com companies would achieve unprecedented growth rates without solid evidence or realistic financial models. Confirmation bias and herd mentality were prevalent during the bubble. Investors ignored warning signs and focused on information that confirmed their optimistic views. The widespread belief that the internet would revolutionize business and create enormous wealth led to a collective overconfidence, contributing to the bubble's expansion. The bubble bursts. The crash of 2000. Signs of trouble began to emerge in late 1999 and early 2000. Rising interest rates, declining consumer confidence, and increasing corporate losses signaled a weakening market. Key indicators, such as the Nasdaq Composite Index, began to show cracks, with a sharp decline starting in March 2000. Data shows that the index lost nearly 80% of its value by the end of 2002. The market collapse began in March 2000, with a sharp sell-off of tech stocks. Major companies like Pets.com and Cosimo.com failed, leading to a significant drop in stock prices. The collapse was swift and severe, with the Nasdaq dropping from over 5,000 in March 2000 to around 1,100 by October 2002. Visual aids and charts illustrate the dramatic decline in stock values. The psychological impact of the crash was profound. Investors experienced panic selling, loss aversion, and a shift in market sentiment. The crash led to widespread financial losses and a re-evaluation of risk and reward in the tech sector. The once unshakable confidence in internet-based companies was replaced by skepticism and caution. The aftermath and recovery. The aftermath of the crash saw significant financial and personal impacts. Many investors lost substantial amounts of money, and numerous tech companies faced bankruptcy or restructuring. The crash led to a wave of consolidation and a focus on achieving profitability rather than pursuing rapid growth. Data on the financial losses and company closures provides a clear picture of the post-bubble landscape. In response to the bubble, regulatory changes were implemented to prevent future market excesses. The Sarbanes-Oxley Act of 2002 introduced stricter financial reporting requirements and increased corporate accountability. These reforms aim to improve transparency and protect investors, shaping the future of financial regulation. The dot-com bubble taught valuable lessons about due diligence, skepticism, and understanding market fundamentals. Investors learned the importance of evaluating companies based on financial performance rather than hype. The psychological impact of the bubble highlighted the need for a balanced approach to risk and reward. Legacy of the dot-com bubble. The dot-com bubble had a lasting impact on the technology industry and business practices. While many startups failed, the bubble paved the way for the emergence of successful tech giants like Google and Facebook. The evolution of the internet economy continued, with new business models and innovations shaping the digital landscape. Comparing the dot-com bubble to recent market trends, such as the rise of cryptocurrency and social media stocks, reveals both similarities and differences. The speculative nature of these markets echoes the behavior of the late 1990s, but advancements in technology and regulatory changes have influenced market dynamics. Reflecting on the psychological and behavioral lessons from the dot-com bubble, we see how investor behavior, market cycles, and innovation play crucial roles in shaping economic growth. Understanding these factors helps investors navigate future market trends and avoid repeating past mistakes. In summary, the dot-com bubble was a complex and multifaceted event driven by technological innovation, speculative investment, and psychological factors. The bubble's rise and fall offer valuable insights into market behavior and investor psychology. By understanding these lessons, we can better navigate the ever-evolving world of finance and technology. If you found this exploration of the dot-com bubble insightful, make sure to like, subscribe, and hit the notification bell for more in-depth historical analyses and financial insights. Share your thoughts in the comments below and let us know what topics you'd like us to cover next.